Global stocks begin the week at record highs after soft US jobs data on Friday night boosted hopes the Fed will cut in September. European markets are on tenterhooks for French election results, and inflation in Thailand and the Philippines is weaker than expected. That's coming up in our 5 Things in 5 Minutes. And then, in our bonus deep dive interview, ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, explains how exports are driving growth in Asia as consumption and investment moderate.
We also have to be mindful and we have to be nuanced about this. In the sense, should demand in the US falter or US growth slow down, it would hurt Asian exports.
But first, in 5 and 5 with ANZ, markets will focus this morning on French parliamentary election results, where initial exit poll results show Marine Le Pen's far-right Nationalist Party is set to lose to a coalition set up to block her. ANZ Group Chief Economist Richard Yetzinger says 2024 was always going to be a year for watching elections, and the surprises have been ramping up going into the second half of the year, especially in India, where Narendra Modi underperformed expectations, and in France, where the prospects for a far-right government at odds with President Emmanuel Macron really worried markets.
Then we had, obviously, Biden's debate performance where the repercussions rattle on. The year of elections very much is here. And while maybe one thing you can say is anticipating the timing of elections and forecasting the results are both proving to be extremely challenging, we can be confident that this is a very different political world from what we've seen for the last couple of decades. Politics is in flux everywhere.
Number 2. US jobs figures on Friday night were softer than expected overall, which increased market expectations of a Fed cut in September to 79% from 66%. That drove the US 10-year Treasury yield down 7 basis points to 4.27%, and the S&P 500 up another 0.5% to a new record high. Those lower yields dragged the US dollar broadly lower. As of 5 a.m. Sydney-Melbourne time, the Aussie dollar was up 0.3% to 67.48 US cents, and the Kiwi was up 0.5% to 61.45. ANZ economist in London, Bansi Maravani, scoured through the detail of Friday night's non-farm payrolls data. She pointed to a higher unemployment rate and revisions lower in previous numbers as signs of a soft US jobs market.
If you look at the monthly payroll gains this year between January and June, payrolls have risen on an average 222,000 per month. And to put that into context, a Congressional Budget Office report from a couple of months ago estimated that non-inflationary rate of job gains in the US economy is around 200 to 230,000. By that yardstick, the US labor market will be disinflationary in coming months. The Fed are going to be very keenly watching that.
Number 3. Britain's bond or gilt markets reacted cautiously on Friday to the landslide election win for Keir Starmer's Labour Party. But pound sterling was more celebratory. Here's ANZ's head of FX research, Marjabeen Zaman, who says lower US yields are also helping to strengthen sterling.
It's quite interesting to see that the gilts market reaction to the announcement of UK elections was much more muted than what we saw, let's say, in this French snap election announcement. I think we have seen the sterling, rally over already. I think that's coming from the weaker dollar. We have seen US yields move lower.
Number 4. Thailand's inflation rate in June was just 0.62% from a year ago, which was less than market expectations. ANZ Asia economist Crystal Tan says the Bank of Thailand will be wary of a bounce-back in inflation.
Today's downside surprise to inflation on its own is unlikely to trigger monetary policy response. The Bank of Thailand has made it clear it considers not just available data, but also the outlook. And then when you have growth set to pick up, given backloaded budget disbursement, and also other considerations such as currency volatility, we don't think the Bank of Thailand is going to be in any hurry to adjust its policy settings.
Number 5. Inflation in the Philippines was just 3.7% in June from a year ago, which was down from 3.9% in May and below market expectations, which were also around that 3.9% mark. ANZ economist Arindam Chakraborty says lower than expected electricity prices were the swing factor. He says, though, the central bank will also be wary of an inflation rebound from food and fuel and transport in particular.
Overall, inflation will remain elevated in July and will start easing in August, aided by a favorable base. We think the BSP will have to wait for inflation to sustainably move towards the midpoint of its official 2 to 4% target range before it can start cutting its policy rate. We do not expect the BSP to move ahead of the Fed, as it will exert depreciation pressure on the peso.
Narendam Chakraborty there. Now, in our bonus deep dive interview, ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, tells my colleague Alex Tarrant about how Asia's economic outlook is dependent on exports as consumption moderates.
When we look at or dissect the first quarter GDP numbers, there's been an improvement in the contribution of net exports. And for most economies, we have seen that export growth has picked up after a very prolonged phase of weakness. Now, what is interesting about this is that exports to the US have emerged as the main driver, whereas demand from the EU and China remains quite soft. And that's an opportunity. It reflects partly a reshifting or sort of reconfiguration of global supply chains. It also reflects the strength of the US economy in driving Asia's exports. But at the same time, we also have to be mindful and we have to be nuanced about this, in the sense, should demand in the US falter or US growth slow down, it would hurt Asian exports. Now, within that also, we notice there is a slightly good sort of backdrop for Korea and Taiwan, who are engaged in sort of advanced semiconductors, memory chips, etc. And that is related to demand for AI, and that could well be a structural development. So in that sense, these two economies are likely to continue to stay on a solid path as far as exports are concerned.
And then looking to other sectors, you talk about how household consumption has moderated. Why is that? Is it due to restrictive policy?
It is a function of several things. The first, as you pointed out, it is due to higher interest rates, and that sort of decreases the propensity of households to spend. They'd much rather put their money in fixed deposits, etc. The second is that even though labor markets in Asia are quite solid, we are not seeing any incremental progress in terms of dropping unemployment rates, faster wage growth, etc. So that's another obstacle. The third is really the fact that post-COVID reopening, we had a surge in demand, and that has now normalized. So each of these three factors are now contributing to what I want to say a more tame growth in private consumption.
And then just looking at the other main themes for the region as a whole, you mentioned how private investment has been weak, which is that surprising given the increased export demand? You'd think perhaps private investment on the manufacturing side might be higher?
I think that even though exports have become much more solid, there is still a very differentiated pace of recovery. Second, there is still, despite that, it's not strong enough to sort of bring capacity utilization levels to a point where investment would take off. In fact, the two economies that we could identify over here which do have these features, i.e. high capacity utilization, new investment coming up, potentially really are Malaysia, South Korea. I would also put India in a separate category because India has much more stronger domestic demand dynamics, and we do think that capex in India would also improve. But that's where it stops.
And then just turning to the forecast then with those themes in mind, what are you expecting now for Asian GDP across the rest of the year?
The forecasts are fairly sort of stable, and we've had them for a while now in terms of GDP growth. Where I think we have changed a lot is really the path of monetary policy. If you recall, at the beginning of the year, we had several banks we had penciled in would be cutting policy rates this year. And as of now, with this sort of higher for longer theme that's persisting in the US, we now think there are only three central banks in Asia, that's mainland China, South Korea, and India, that would be able to cut rates, and that too by fairly minor amounts. For most economies, it is in 2025. Even then, there is one economy or sort of economies that have done very little in terms of the rate hiking cycle, and that really includes Malaysia. We think they will abstain from rate cuts even in 2025.
Sanjay Mathur there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, July the 8th. Catch you tomorrow with a preview of the Reserve Bank of New Zealand's decision due on Wednesday. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.